At first glance, the story sounded familiar. A bold electric vehicle startup, big promises, revolutionary design, and a mission to disrupt the automotive industry. But the more you look at the details, the more cracks begin to show. And lately, those cracks have turned into fractures. Today, we're continuing our deep dive into Aptera, a company that recently became publicly traded and has, in a surprisingly short amount of time, raised even more questions about whether it can survive at all. Since going public, new disclosures, financial filings, and company updates have painted a picture that looks far less optimistic than the narrative Aptera has been presenting for years. What once sounded like an ambitious vision now increasingly resembles a collection of unfinished ideas, unclear timelines, and promises that don't quite line up with reality. Let's walk through the most recent developments and what they really suggest about Aptera's future. Over the years, Aptera has produced several pre-production prototypes, each one positioned as a step closer to mass manufacturing. In mid-2025, the company unveiled what it described as its most advanced prototype yet, a vehicle known internally as Artemis. While it was framed as a major milestone, Artemis was still nowhere near production-ready. Despite that, Aptera sent this prototype out for a public review later that year, presenting it as evidence of progress. The feedback, however, raised serious concerns. One of the most obvious issues was visibility. Because the rear of the vehicle is covered in solar panels, it lacks a rear windshield entirely. That means no traditional rear-view mirror. The solution is supposed to be a rear-view camera, yet on this prototype, that system wasn't even functional. A missing safety feature on a vehicle being showcased as a major leap forward is already a red flag. Visibility problems didn't stop there. The side window design included a thick structural border positioned directly at eye level, obstructing the driver's view in a way that would be unacceptable in a production vehicle. The wheel covers sat extremely low to the ground, leaving only a couple of inches of clearance. In real-world conditions, that would make driving in snow nearly impossible and could cause the vehicle to struggle with even modest speed bumps. Then there's the windshield. Due to the vehicle's curved shape, glare becomes a serious hazard. The reflection is severe enough to compromise safety, and it's not a problem that can be fixed with a minor adjustment. Addressing it would likely require a fundamental redesign of the vehicle's shape, which raises an uncomfortable question. How close to production can a vehicle really be if its basic geometry still presents unresolved safety risks? Design flaws are one thing, manufacturing reality is another, and this is where the situation becomes even more troubling. Aptera has stated that it plans to begin low-volume production sometime in 2026. Initially, this production is supposed to happen inside the company's headquarters building in Carlsbad, California. The problem is that this facility looks nothing like a modern vehicle factory. Recent footage released by the company shows a small, crowded space where both vehicles and solar panels are assembled. There's no room for scale, no visible automation, and no sign of the efficiency needed to produce vehicles at a competitive cost. To understand how unusual this is, it helps to compare it to a real automotive factory. In established facilities, vehicle production is highly automated. Industrial robots assemble chassis at high speed. Cars move continuously along an assembly line. Workers perform specific tasks with precision, optimized down to the second. Aptera's setup looks like the opposite. There are no industrial robots, no moving assembly line. Welding is done by hand. Components are carried from place to place by individual workers. This is closer to artisanal manufacturing than modern industrial production. It's the kind of process that existed long before mass manufacturing made cars affordable and scalable. What makes this even more concerning is that Aptera has previously claimed it would rely on advanced manufacturing techniques. At one point, the company talked about using automated guided vehicles to move tricycles between stations. Yet, in the footage of the production floor, none of these systems appear to exist. Instead, everything is manual. Frames take an entire day each to assemble, and even then, these frames aren't destined for customer vehicles. They're being used for internal validation and testing only. This brings us to another confusing aspect of Aptera's development process: the growing list of prototypes. Artemis, the vehicle that received so much attention, will never enter production. Instead, Aptera has introduced yet another prototype called Gemini. Gemini is described as a production-weight validation vehicle intended for range and efficiency testing. But even now, there's no confirmation that Gemini itself will ever be produced at scale. Footage of Gemini reveals a vehicle that still looks unfinished. The interior lacks padding. Bare carbon fiber is exposed. The steering wheel appears incomplete with visible wiring. These details suggest a vehicle that's still in a very early stage of development, not one preparing for regulatory certification. Company leadership has referenced internal testing and preliminary evaluations, but there's no indication that formal certification testing has even begun. This is especially problematic when you consider the timelines executives have publicly stated. Shortly after the company went public, leadership suggested that once financing was secured, production could begin within 6 months. Based on that timeline, production should be well underway by the middle of 2026. Yet what we're seeing today doesn't resemble a company that's months away from manufacturing customer-ready vehicles. It looks more like a company still experimenting in a workshop. While the product and manufacturing concerns are serious, the financial picture may be even more alarming. Aptera has claimed that it plans to generate revenue not only from vehicle sales, but also by selling its solar panels to other companies. One such company was described as a paying customer receiving weekly shipments. On the surface, this sounded like a meaningful step toward diversified revenue. But financial filings tell a very different story. In its most recent quarterly report, Aptera disclosed that it generated 0 revenue during the entire quarter. More importantly, the management discussions section explicitly states that as of the filing date, the company had not commenced production or generated any revenue from product sales. This statement came weeks after executives publicly described shipping solar panels to a paying customer. These two narratives don't align. If shipments were happening regularly and payments were being received, that revenue should appear in the company's financials. The absence of any reported revenue suggests that either the amounts involved were negligible, contingent on future conditions, or simply not occurring as described. Whatever the explanation, it raises serious concerns about transparency. At the end of the quarter, Aptera reported having roughly $12 million in cash. During that same quarter, the company burned about $4.5 million, which translates to roughly $1.5 million per month. At that rate, the company has less than a year of runway left. Despite this, capital expenditures have been minimal. Over 9 months, less than $1 million was spent on property and equipment. That helps explain why the production setup remains so rudimentary. To fund operations, Aptera plans to rely on an equity line of credit that allows it to sell shares into the market. While this provides access to capital, it comes at a cost. The structure limits how many shares can be sold at a time, forcing the company to raise money in relatively small tranches. Each time shares are sold, it adds downward pressure on the stock price. As the price falls, more shares must be sold to raise the same amount of money. This creates a dangerous feedback loop. Dilution leads to price declines, which lead to more dilution, which drives the price even lower. Since becoming publicly traded, the stock has already lost a significant portion of its value. Continued reliance on share sales risks pushing the company into a dilution spiral that becomes increasingly difficult to escape. Taking all of this together, the overall outlook hasn't improved. If anything, the evidence has reinforced the same conclusion time and again. The company still hasn't demonstrated validated performance data. It hasn't proven it can manufacture efficiently. It hasn't generated meaningful revenue. And it continues to introduce new prototypes without a clear path to production. Going forward, there are only a few things that could meaningfully change this picture. The company would need to explain why no revenue has been recognized despite claims of paying customers. It would need to release independently verifiable efficiency and performance results. It would need to clearly state whether Gemini is actually the vehicle that will enter production. And, most importantly, it would need to show a credible plan for manufacturing vehicles at scale and at a profit. So far, none of those boxes have been checked. Producing vehicles by hand inside a small headquarters building is not a viable long-term strategy. Without major changes, it's difficult to see how this story ends any differently than many ambitious startups before it. That's where things stand right now. The promises are still bold, but the evidence keeps pointing in the same direction.